Welcome to Zak Wealth Files. Look, if you've ever agonized over the decision to rent or buy a home, you've probably turned to the internet, plugged your numbers into a rent versus buy calculator, and just waited for the magic answer. It's a completely relatable pain point for so many of us trying to build long-term wealth. But here is the truth. Those calculators are hiding something from you. Today, we're breaking down the real 2026 mortgage math and building a framework for your specific situation. Okay, let's dive into this.
We've all seen the exact kind of clean, confident-sounding answer I'm talking about. Buying wins after 5 years, or renting is better for now. Boom, done. But what almost none of those calculators make obvious is that there is a single, hidden assumption doing most of the heavy lifting behind that number. Depending on what you assume for this one variable, the entire right answer can flip completely. In this explainer, we are going to look at why that clean answer is incredibly misleading, and how understanding one hidden variable changes absolutely everything. Let's start with the current baseline numbers, because 2026 genuinely looks very different from just a few years ago. You just cannot rely on conventional wisdom from 2021 to make decisions today. 30-year mortgage rates are currently sitting in the 6 to 6.5% range. While that's an improvement from recent peaks, it's a massive shift from the 3% range a lot of buyers locked in back in 2021. Think about this comparison on the exact same $400,000 home. Financed at 3%, your monthly principal and interest payment is roughly $1,686. That exact same home, financed at 6.5%, costs around $2,528 a month.
That is an extra $842 every single month. And I really want to emphasize this. That extra money is absolutely not getting you a better house, a bigger yard, or a nicer neighborhood. It comes purely from the change in the interest rate.
At the same time, we need to look at another crucial metric called the price-to-rent ratio. It's a bit of jargon, but the concept is super simple. It is literally just the median home price divided by the annual rent in a specific market. Right now, the national average for this ratio sits around 31% above its long-run historical baseline.
So what does that high ratio actually mean for your wallet? It means that structurally, the math is heavily tilted toward renting being cheaper on a pure monthly cash flow basis in most major metro areas right now. Because of this dynamic, most current analysis show that the general break-even point, the year where buying mathematically overtakes renting, is landing anywhere in a massive range between 4 and 14 years. It is not a single universal number. So if the break-even range is anywhere from 4 to 14 years, what actually determines where you land on that spectrum? This brings us to the single most important and honestly most consistently underexplained assumption in the entire rent versus buy decision. When you rent instead of buy, you are not spending tens of thousands of dollars on a down payment. You aren't paying closing costs, and you aren't paying the portion of a mortgage payment that goes toward interest, property taxes, insurance, and maintenance beyond what your base rent would cost. This is where the concept of opportunity cost comes in. In theory, a disciplined renter takes that difference, all the money not spent on those ownership costs, and invests it instead. Now, watch what happens when we adjust the assumed return on that invested difference. It completely flips the outcome. This is the hidden variable. Using a detailed 2026 analysis, if you assume a conservative 4% annual investment return on your unspent cash, buying breaks even and wins around year 12. But assume a 5% return, that break even stretches out to roughly 17 years. And if you assume a 6% return, which is actually closer to long-run historical stock market averages, renting can come out ahead for the entire 30-year period. No way, right? Why does this happen? Because the invested difference compounds like a giant snowball rolling down a hill, growing faster than the home's value appreciates over that same exact span. But here's the kicker, and this is the part most people get wrong. It requires you to be brutally honest with yourself. Neither assumption is objectively correct. It depends entirely on a behavioral reality. Will you actually invest the difference? If the money you save by renting just sits in a checking account earning absolutely nothing, buying looks dramatically better. If you consistently invest it, renting looks incredibly competitive. So the question isn't just about market variables, it's an honest question about your own personal financial discipline. Let's move to the second major factor that dictates the mathematical outcome, which is exactly how long you actually plan to stay in the property. Nearly every analysis agrees on this timeline. If you plan to stay 0 to 3 years, renting is almost universally the stronger financial choice. Why? Because upfront buying costs are typically 2 to 5% of the home price, plus another 6 to 8% in selling costs when you finally move. You need time for built-up equity to offset those massive transaction fees. If you're staying 10 plus years, buying is heavily favored. The genuine uncertainty lives right there in the middle, that 4 to 10 year gray zone, where the outcome is highly sensitive to your local market and your specific investment returns.
So you're probably wondering, how do you quickly figure out where your target home sits in all of this? Well, I want to give you a practical, quick math shortcut you can use this week to gauge your local market. We call this the 5% rule. Step 1, take the exact price of the home you are looking at. Step 2, multiply that price by 5%. Step 3, divide that number by 12. That final number gives you a rough monthly break-even rent figure. If actual comparable rents in your specific area are meaningfully below that number, renting is likely the stronger near-term financial choice for that specific property.
You can also use those price-to-rent ratio tiers we talked about as a broader reference point. If the ratio in your market is under 15, the math fairly clearly favors buying. If it's in the 20 to 25 range, you are in neutral territory where other lifestyle factors will really make the decision for you. And if the ratio is above 25, the math tends to heavily favor renting. This helps you interpret what the numbers actually mean for your wallet, right now, in your specific zip code.
Remember, clarity and trust beat excitement, and the real excitement should come from that clarity. So let's turn all of this into a concrete action plan you can execute immediately. Here is your 5-step framework. First, get real, current numbers, the actual rate you'd qualify for, and actual local rents, not just generic regional averages. Second, honestly estimate your stay, and critically stress test the shorter end. Underestimating how soon you might move is a massive financial mistake. Third, use a rent versus buy calculator that actually lets you adjust that hidden investment return variable and run it at a few different rates. Fourth, assess your investment discipline. Will you honestly invest the unspent money? And fifth, factor in the non-financials. Stability, the ability to renovate, and freedom from maintenance all carry real lifestyle value that a pure spreadsheet simply cannot capture.
Now, a quick but honest caveat before we wrap up this explainer. This breakdown reflects general, publicly available 2026 data. It is not personalized financial or real estate advice. Real estate markets vary enormously, home prices can decline as well as appreciate, and obviously, investing carries risk. Always consult a local real estate professional and a licensed financial advisor to run these numbers for your individual situation.
The absolutely crucial point we are walking away with today is this. Relying on generic calculators without checking that hidden variable is a major financial mistake. Rent versus buy simply does not have a single universal answer in 2026. If a source tells you there is a guaranteed answer, they are skipping over the assumptions, doing the actual work. Clarity and honest personal behavior will always beat default spreadsheet assumptions. Running the numbers with your own honest assumptions is the only way to get an answer that is actually correct for you.
So, I've got to ask, and I want to hear from you on this. Let me know down in the comments, are you currently renting or buying? And more importantly, be totally honest with yourself. Are you actually investing the difference? If this framework gave you a clearer, more honest way to think through one of the biggest financial decisions you'll ever make, be sure to subscribe to Zak Wealth Files for more real numbers breakdowns. I'll see you in the next explainer.